Thank you everyone for making time to join us this evening. My name is Sharon and I'll be your host for this webinar. So just some house rules as we continue, please feel free to ask questions through the Q&A chat. Feel free to engage or comment through the chat section. We'll also have a few polls throughout the webinar. Please do feel free to engage and share your feedback with us. Otherwise, I hope that you enjoy the presentation and that by the time you leave here, you'll know how to choose the best funds for your financial goals. So without taking too much time, I'd like to invite our speaker for the day, Jonathan, to introduce himself and take it away.
Right. Thank you, Sharon, for the introductions. Good evening, everyone. My name is Jonathan. I work at Ndovu, the Investment Operations Division. So today we're going to touch on a very interesting topic that is technically ETFs, mutual funds, or what we know as unit trust or the famous money market funds. All right, so as an overview of what we are going to technically tackle in this webinar would be what are money market funds versus what you can hold in a bank, integrating your money market fund into your investment strategy, then a brief look at the regulatory overview, and then simply questions and answers. Right, before we get anywhere, we can appreciate the history of the Ndovu, and it's quite an exciting experience because I've been part of it together with the co-founders. I've seen the growth of Ndovu as a company. All this started off in 2022, where we got an investment advisor license. That is exactly in February of 2022. We launched the same month, and excitingly, we progressed so fast that by June, we had our fund manager license. On top of that, exciting activities have happened in the space, and we managed to get licenses in Rwanda. That is in January of 2024. And now we have grown to the extent that we are able to offer the famous money market funds. And this started off when we got our approval in February of 2024. All through the phase, we have managed to get about plus 60,000 users, plus 600,000, and an average return of the different funds that we have. And we'll touch on the basic ones, which is the ETF money market funds, and the other available, have an average return of about 13% to 20%. Right, the next is just our co-founders. We have Richard Ashley, Radhika, GP, and Ro, who form part of the team that brought Ndovu to play. So let's discuss effectively the topic of today. We are going to start with the ETFs. I know you've heard of this name before, ETFs. What are they? What do they stand for? And if you've had an advantage of signing up onto our platform, you've been able to bond with the ETFs. But today, we are going to just understand first what the ETFs are. So by the name, they are known as exchange-traded funds. Well, traditionally, if we'd like to buy a stock, you would only buy a single stock. In this case, if I want to buy Apple, then I'd go to the stock market and get a share of Apple. This means that I am exposed to the market movements of the Apple stock. So if I get an additional amount of money, I can decide that I'd like to invest also in Visa. And if I get another additional amount, I can invest in Intel. Then I can proceed to NVIDIA, then Microsoft. So I'm building a portfolio of different stocks or counters that I'm trying to add on to my portfolio. I can again decide to buy PayPal or also MasterCard, Adobe, if I would like. But there are things that we have to consider. Buying these individual stocks as an individual becomes a bit pricey, because for each and every stock, you have to spend a certain amount. So it becomes a bit pricey, and you'll have to spend quite a huge amount of money. Then comes ETFs. What it does, all these stocks or securities can be bundled together and become a basket of securities. And you can go onto the various platforms and buy an ETF. In this case, we have an ETF called the Vanguard Information Tech ETF that has all these counters and more. I've just mentioned the most famous counters. And once you buy this ETF, then you get full access to all these firms or company. So it means that you are investing technically in a basket of securities. So the next question is, how does this then advantage me as an investor? To answer this, then we look at number one, the risk. When I invest in Apple alone, if today something happens to Apple as a company, then technically the prices of that specific stock would technically decline. And so I'm only exposed to one stock and I'm dependent on its movement. But if I buy a basket, then it means that diversification has been done. And I'm not only exposed to one, but to multiple. So in this case, if Apple does not perform, say this year very well, Visa, on the other end, would perform quite very well. A good history, and if you look at ETFs, if you look at even from when it started back in 1993, when we had the S&P 500 being the first ETF, at that time yet, investors had not well understood the product. They were focused purely on the mutual funds, on what we are going to technically discuss and what it is. But over the years, it took about a decade. This is up until the year 2000, when people started now appreciating the benefits of ETFs. So the risk level of an ETF ranges between moderate to high, depending on the specific ETF that you've decided to invest in. There are more than 1,000 ETFs globally. So there's a lot to buy and sell technically on the ETF space. How to enter and exit? They also have low charges technically. So you're not exposed to high fees. So since you have discussed briefly on what an ETF is, we can also touch on the famous money market funds. So the question is, what are money market funds? Money market funds in itself, if we look at the technical definitions, it is a unit trust. And a unit trust is just a type of an investment. How does it work? This is where people with the same goals would be able to come together and pool their funds and then be able to invest. Now, you've seen the first difference between a money market fund and an ETF. An ETF, basically, we spoke about a basket of securities, but when you're coming on to the money market funds, we are speaking about pooling funds from different investors. And what does that do? The key advantage normally of this arrangement is that if you come with your money, 500, 1,000 shillings, 10,000, 20,000, when we pool together our funds, we have what we call the economies of scale. Now we can be able to take advantage of that, meaning that the fund will be able to invest their money into different asset classes. And we'll touch on what asset classes are. And then what that does is that we are able to get competitive returns from these specific funds. Another advantage is that unit trusts are regulated by the Capital Markets Authority. So the Capital Markets Authority technically is the regulator for the money market funds or the collective investment schemes in general. And so this space is highly regulated. So off the technical down to the basic definition, think of it as a pie or a pizza, meaning that there are different pieces to it. So together, if you pool different individuals, if it is a pizza that you're looking at, if you pull the different pieces, then at the end of the day, we come up with a big pie or a whole pizza. So in this case, by buying a unit onto a money market fund, what that does, it is that it offers you a piece of this pie. So in this case, once you purchase the units, then you fall within the pool of investors. And with this, then technically, we would start asking ourselves, what are the benefits of a money market fund? That would be quick access of funds, meaning that they are liquid. The ease of entry and exit is quite easy. Number two, since you've pooled the funds together, these funds are invested by professional fund managers who make sound decisions. And remember, the last point on the previous slide, we talked about the aspect of the regulator. So they're heavily regulated in that aspect. They enable you to enjoy the benefits of compounding returns. This term, compounding returns, you'll be able to see its amazing effect on the subsequent slides. Then we have capital preservation while getting inflation protection. Inflation in general, as we know by definition, is the, in a basic definition, the increase in, overall increase in prices of basic products and certain products which are within a certain index. So you find that money market funds in general will be able to offer you a return, capital preservation, but then again, their returns are at least higher than the inflation rate within the economy. Then with the pooling of funds, then you have the aspect of diversification. Diversification is, not putting on your eggs or, in one basket. So you invest in different asset classes in general. Then another benefit is they have lower minimums. You can have a minimum of 500 shillings, as low as 500 shillings. So they offer an opportunity for anyone to enter and enjoy the economies of scale. Then on a daily basis, you see that you'll be able to see that the returns are credited to your account. So periodically, that effect will be able to be seen on the account. And then finally, I can't stress this, that they have the regulatory oversight. So as I mentioned, that the next question you would ask is that, okay, they offer returns better than inflation. So how exactly do they invest the funds? The funds are invested by professional, as I said, fund managers who invest in different asset classes generally. So as per the regulations, at least the average term of this investment should be 18 months maximum. So that means you have treasury bills. So treasury bills in Kenya, we have three. We have the 90-day treasury bill, we have the 182-day treasury bill, and we have the 364-day treasury bill. The next question you'd ask is who issues the treasury bill? This is the Kenyan government that issues the treasury bill. And what typically happens on a weekly basis, you'll be able to see the Central Bank of Kenya issue treasury bills. Then we have fixed deposit instruments. These you've interacted with in your bank, where you have different kinds of fixed deposits being provided. There are also high quality corporate commercial papers. These are issued by entities. For example, BAT may decide to issue a commercial paper. Safaricom may decide to issue a commercial paper. Then the other thing is near cash holdings. So after discussing the money market funds, at Ndovu generally, we have a money market fund, which is called the Ndovu Fund. Currently, as you can see, at the annualized return of about 15.51%. And what it is what we have been able to learn at the start, that it is aimed at providing a high level of income compared to that of bank savings. What are the technical features of this fund? The base currency is Kenyan shillings. The return, as you've mentioned, on a daily basis, you'll be able to see that your value keeps on increasing with the day. So even that once they have done the various investments, then the return are well distributed among the unit holders. The other question is risk. Money market funds have a lower risk, meaning that risk governed based on your principal investment. So you find that once you invest your amount, then the possibilities of the investment amount, the variations of how it's going up and down is not as much compared to other products. And we'll be able to technically look at them when we get to the meat of things. Then liquidity, they're moderately liquid. Then investment, short-term, as I mentioned, anything below 18 months. The initial investment that we have is 500 shillings. Taxation is subject to withholding tax on interest. And then again, as I had mentioned, the regulator is heavily regulated. All right. So after we have done the definitions of all these funds, the question is, you'd ask me or yourself is, all right, how does this thing exactly work? How does this compounding effect work? Picture a scenario before we get, and compounding is a discussion. Picture you saving a shilling every day, and on the next day, you add another shilling. So if the first day you've invested a shilling, the next day you invest 2 shillings, the next day you double that, you'll find that after a period of 364 days, that's equal to a year, you'll have gained as much. The power of compounding. So let's get to the discussion. So if you decide to invest your amount in a money market fund, generally, and they're offering a return of 15%. I managed to populate figures of how much someone can make within a period of time based on the contributions. So if we decide to contribute an amount of 100,000 Kenya shilling, and periodically, meaning on a monthly basis, you tend to contribute the same amount. Technically, what this means is that after 5 years, you'll be able to get a total of 9 million shillings from the periodic saving. The same scenario happens even if you put 7,500 shillings and you contribute monthly 7,500, then technically, after 5 years, you are able to get 680,000 shillings. The power again of compounding. This is a money market fund. If we compare this to a bank, same when you make a deposit on a bank, you let your money sleep in the bank. I know we have different kinds of individuals, some that love to view their bank statements, and then once they see it, they can technically just move on and sleep happy. But look at this. The same amount of money invested, 100,000 in 5 years, that gives you 6.58 million shillings. So if we look at the difference, that's technically about 2.5 million that has been left on top of the table, an opportunity that can be taken advantage of. What can we do with 2.5 million? A lot of things. Not only buying a car, land somewhere, reinvesting the amount, remaining liquid. So there's an opportunity that has been lost by not investing that money onto the available investment vehicles that we have. So we have touched on ETFs, and we have mentioned something important about the structure of an ETF. We say that it puts together a basket of securities. And one thing that I didn't mention is that they are traded on the stock market. So what that means is that when you're looking at the movement of an ETF in terms of return, in terms of their movements, they're dictated by its performance in the stock market. And so you can invest in an ETF today. Come tomorrow, you might see a decline because we've said the risk in itself is moves from moderate going up. So it can fluctuate. The discussion here is the potential of that fund on making a return. And how do you achieve that? You achieve that by the simple image on our screen. There's an excitement when you want to technically invest in anything. That's why you find that you might be attracted to something and you'd like immediate returns. So investing, you can look at it in a similar manner. When investing in ETFs, number one, you must analyze technically your risk levels and be able to discuss on how the ways and means for you to assess your own risks so that you can be able to make informed investment decisions. So let's say, for example, you have invested in an ETF. The potential return is high, but you have to give it what we call time. So if you look at the image, the first individual is mining for diamonds and is quite excited that they'll be able to reach the diamond immediately. But what happens is that the aspect of time is not well considered. So you find ourselves exiting within a period of time. So in this case, most of the time, at the point when we exit, we are just near to the diamond. So when I say long term, these two products, and when we get to the next section, you'll be able to see how you can gauge the two products to benefit you as an individual. So at the end of the day, let's be the person who manages to mine and get to the diamond and not give up at the end. And this is why. All right. For those who are our investors, you have the ETFs onto your portfolio and have enjoyed the benefits that the ETF has. We, as mentioned in the second slide, we have what we call a money market fund within the platform. But before I get to that, many of the financial terminologies that we have mentioned, we have talked about the product. But the most important thing is the money. You must, in a case, invest some amount. So there's some 6 steps that you can follow to get to this point. And now at this point, I'll be able to bring in the 2 products so that we just gel and understand where we can place the various products. So we have, number 1, you have to budget. And budgeting, we start with even the small costs that we incur when we are doing our usual mobile money transfer. You know, there's some costs that we don't really realize, but once you sit and analyze how much you've been able to spend within a period from the smaller expenditures, you find that they're quite a lot. So number 1, a budget is important. And a budget only has what we call expenses and how much you earn. Then after that, of course, once you do a budget, you'll be able to see even the debts that you have. And so you can be able to look at ways of reducing the debt. Because once you reduce the debt, it will allow for some disposable income to be used. And once you get that disposable income available, when I say the amount, it doesn't depend. Remember, investing is a journey. So even if you have managed to turn 500 or 1,000 shillings, you have some extra money. You can decide to buy something with that money, but it is important to set up what we call an emergency fund. Simply put, a rule of thumb, an emergency fund, you can just look at your expenses. Remember, you have a budget that you have indicated in the initial part. With that budget, you technically know your expenses, those that you can't survive with. And then once you do that, then technically your emergency fund can be 6 months of those expenses. And with this emergency fund, it means that you'd like to invest it in something that, yes, would earn you something, but at the end of the day, I can be able to access it when the emergency hits. And that's where now the money market fund plugs in. As we've said earlier, it's short term, it allows for short term. Number 2, we've said its risk level is quite low. It's a low risk investment. And the liquidity, it offers what we call liquidity, the ease of entry and exit. And so what that does is that it offers you an opportunity to structure an emergency fund with it. Once you have built an emergency fund, we move to the next step. We invest wisely. And how do we do that? We incorporate other factors into our portfolio. Remember, when we have invested in a money market fund, it depends on the rates. Currently, money market funds would range at a rate between 14, 17, or 18% thereabout. But there's a potential to even earn higher than that. Because what will happen is that once we know the areas of investing and where we're putting in money and where we are losing money, then we'll be able to earn even some additional funds. So what we do with those additional funds, we invest. And so when we're investing, we go long term now. When we go long term, we have now the ETFs, which I mentioned. Yes, the risk is different from what you have on a money market fund, and it requires what we call time. So it's a bit long term as compared to a money market fund, which is short term in nature. So with this one, we don't have the urge of getting in and getting out, say today and then tomorrow just want to exit. No, there's a common phrase that I like to say is that at some point we work for money, but it gets to a point where money now starts working for you. And when money starts working, the only thing you do is rest. So when you have diversified and invested in the different products available, in this case, the ETF, then now that you give it a long term, as you mentioned. If you put all these factors together, what do we get? We get an increase in income. So you will start even wishing you are 60 years and retire very early because money is now working for you. You don't even need to work for the money. So having discussed on those nitty-gritties, we can get onto the allocation aspect. So we have our money at 100%. And now we are starting to build, as I mentioned earlier. We are building an emergency fund. How can we do this? We have the Ndovu money market fund, or the money market funds that are there. Then we have also bank savings to cater for the daily liquidity that might happen. You need to move from this point to the other. Some small money is required here and there. So at least there's some liquid cash in the bank to just cater for needs that you would require at a period of time. So we can put about 20% of the fund, of the funds that we have, onto the money market fund. In this case, the Ndovu money market fund. We have seen the power of compounding and how that technically can affect our return. Number two, we can put a 10% in bank savings to cater for those costs that I mentioned. Once we have tackled the capital preservations, then we can move to the next, which is growth. We want to move from one step to the other. On the growth aspect, now we can be able to invest in global index funds, in this case, the exchange traded funds. So at this place is where now you make money passively. So you grow your money while you sleep. Your investment journey is just simple. You have investors in different counters, upward, because we have different kinds, and I'll be able to touch on the different kinds of examples of ETFs that are available and just touch on a small story. Then once you do all this, then we come up with what we call diversification. So of all this, bank will provide you, of course, low risk, safe, secure, the 10%. So we'll be able to cover up the needs. The cash fund, low risk, and inflation protection. And that's where the ETF technically would come in. And then you have your global index funds. That's passive income, medium risk, as I mentioned, and asset class diversification. So why Ndovu? From that introduction, why would I then invest in your money market fund or your ETFs? Because we can offer all these offerings under one roof. We have the money market funds, we have government bonds in play, then we have the global ETFs that we have said are traded in the stock market. In addition, we have what we call fractional stocks that we'll be able to learn about that probably on our next session. But on this session, we offer not only that, but all this under one roof. We are licensed, again, by different regulators. As seen on the first slide, we are regulated in Kenya, regulated again, so regulator, and it's important. It's part of our principles to always work with the regulator and make sure that we are doing all our operations within the law. Then investments are technically transparent, easy access. Then from this session, I know there are some questions in terms of on a personal note that you might have about technically Ndovu, the platforms and the offering. We have that available, a relationship manager that you can reach and have a conversation, get to know about the product. You know, investing in itself is a journey. I remember when I started my investment journey, I learned the first principle the hard way. I wish someone had told me that. Number one is before at least you invest, you get to understand. And that's why we've discussed the ETF and money market fund. Technically, I didn't understand what I was investing in. Of course, it takes experience for you to gather and of course, professional advice. And then you're able to get to that level where you understand where you are technically investing in. And that's why you find many individuals onto pyramid scheme. In terms of, as we said, transparency is key. In Ndovu, you can be able to track your assets and how they're performing simply by logging onto your app or the web portal that we have. And that provides you what we call the confidence that you would need in terms of tracking your investments. Of course, you have your timeline. Another thing that is to mention is the aspect of discipline. At least you can try to be disciplined with the funds just for a period of time, and you'll be able to gain technically on the returns. So we have spoken of ETFs and mentioned a few of the ETFs and how they operate. But now we have on our platform different ETFs with different returns. Remember, as I've said, ETFs are exposed to the stock market. So technically, past performance is not an indicator of future returns. It doesn't work that way. So how it performed the previous years would not technically promise that it would perform that way on the next years. And that's why the aspect of long-term comes in. Example of funds that we have what we call the Techie Fund. The Techie Fund just has the tech firms in it, you know, the likes of Microsoft and the rest. So they're bundled together onto this ETF. And now when you put your money, in this case, for example, for Ndovu 7,500, then you're able to gain or to be able to get the potential returns by investing in this ETF. We have what we call the microchip fund. This is an ETF that touches on AI. AI has been in the news everywhere, globally, locally, and it is a new thing. And so if you want to get a feel of the AI and you want access to almost all the companies that are in the AI space, then the semiconductor fund technically is your choice. Then of course, our Muslim brothers and sisters, we have the Halal Fund, that is Sharia compliance and follows the principles of Sharia. And we have many others, including the S&P 500 index that tracks the companies that are within that specific index. And what that brings out is that when you see the market performing technically, you are able to see the returns on your end. Right? So as a summary, before the Q&As, we have mentioned the aspect of ETFs, and we've said that they are an opportunity for investing for the long term. And you have the money market funds that offer an opportunity to invest for short term to long term. And they can assist in building an emergency fund and also building your portfolio slowly by slowly, because the compounding effect can make wonders to happen. Then if we look at the return for ETFs technically are dictated by its performance in the stock market vis-a-vis the money market funds, which depend technically on the returns of the various investments. But again, you said they are low risk in nature, they have capital preservation, and they always beat inflation in nature. And then if we look at technically the entry and exit for money market funds, it offers you that liquidity. So that's why the emergency fund is technically important. Right, with that, I'd like to proceed onto the Q&A so that we can be able to tackle any questions that you have for me today.
Okay, so I'll just read what's on the Q&A and some questions that have also come through the chat. So someone is asking, how liquid is the money market fund?
The money market fund is highly liquid, so there's ease. You can enter and exit quite very easily. Yeah, so there are good investment opportunity for that. Thank you for that question.
Okay, Maurice is asking, when does your, I believe he's asking how the interest is calculated, if I'm not wrong.
All right. So for money market funds in general, there is the daily yield that you see on, you normally even see the various newspaper and the annualized return. But how the returns are done, as mentioned, you accrue them on a daily basis. So each and every day, they are distributed to all the unit holders. And remember, for money market funds, you can't say that a money market fund, for example, would mature after a period of time. So their return can fluctuate periodically, but every day you are credited with the daily returns that has been garnered by the fund. So technically speaking, it's simply on a daily basis. For mathematically, you have a year being 364, a day would, how would you get a day technically would be a device of that. But of course, there is a lot of math behind, but simply put, you accrue the return on a daily basis. Thank you.
Okay, there's been a couple of questions about the risk. A number of people are asking whether it's possible to lose money overnight.
Okay, possible to lose money overnight unless you're betting. Betting is the only thing that I know that you can wake up in the morning with bad news that you have not gained from, say, a specific selection. But when it comes to investing, it doesn't work in a similar manner. Remember, as much as ETFs is a basket, so it means that diversification technically is there. You're exposed to different companies, provides passive income. So overnight, of course, we can. That is cannot be doing investing. The possibility of losing overnight that never happens because even markets have specific trading limits and trading times. But yeah, I think that technically is it.
Okay. Another question here is, are money market fund returns net of fees and taxes?
All right, so it depends. Normally, the returns, because every money market fund has a fee. In this case, if you look at the various funds, have a fee between 1% and 2%. So, of course, that comes into play afterwards. But yes, they have a fee to it. And the returns normally are within the levels of gross and net, depending on which return you're looking at, daily or annualized. But yes, there's a management fee to it, and that's for Ndovu Fund, it's 2%. But remember, that's of course not deducted when you make an investment. No, that's an figure. Okay.
Okay. I think someone here is asking in relation to local funds. Is in the current economic climate, do you think Kenya is a viable investment market? Basically, that's what she's asking.
Yes, and that's why we recommend you invest in money market. Why? We have the economies of scale and pooling together of investments allow for one important principle, and that is diversification. Yes, locally, opportunities are technically there, and you can be able to achieve these opportunities by simply just investing in a money market fund. And then investments are diversified. As you've seen, we have treasury bills and bonds. Historically, it is known even by those instruments are known to be risk-free. When they say such things like treasury bills and bonds are dictated to be risk-free, of course, that's a topic for another day, but it's for governments to go under. It is not an easy affair. It's very rare to hear governments technically going under, but yes, not to deviate much from the question, yes, there's an opportunity, and the simple way to do that is move into a money market fund. Pride yourself in being in the economies of scale and simply sit down and relax because your portfolio will be fully diversified. Thank you.
Okay, I think those are the main questions that we have. If you feel that we haven't answered your questions, we will reach out to you for your more specific questions. And as we've mentioned, we offer free financial advisory sessions. So we're going to post the link one more time so that you can get more personalized guidance. And in case of any other issues relating to your accounts, please, you can reach out to us via support@ndovu.co. So I'll give it back to you, Jonathan, maybe to close for us, and then so I just have one more question, but I think we've mentioned this. What are the returns on the Ndovu Fund?
All right, currently, even if you go to the platform, you'll see a return of 15% on the money market fund. So it's there, just simply log in and you'll be able to view the returns. Remember, these informations are available on the platform. So you just skim through the platform and be able to access the fact sheet. It will give you more details about the fund, how it is structured and all that, who are the trustees, custodians, the common questions, and then that would offer you more information about that. Yeah.
Okay, I think I have one more final question and then we can close. Is the management fee on Ndovu Fund charged on interest, principal, or gross?
Okay, so the money market funds in general, just to picture the definitions, this is standard and cut across, simply put, on how management fees are charged. So the thing is that the management fees are only charged. You accrue them, of course, as we've said, is a 364 aspect. So you accrue them slowly, but it is a 2% management fees. And of course, it's charged on the returns once a specific period of time has technically been reached. Yeah. So it's a whole something. It's not specific to, it's from individual as a whole something. Yeah.
Okay. Thank you so much, everyone. We'll definitely share with you the recording tomorrow for those who are asking. Thank you so much for joining us. Jonathan, it's been a pleasure. I believe everyone has learned so much. Please remember to book a session with our relationship managers for a more personalized advice on how you can build your portfolio. And we look forward to seeing you on the platform. Good night, everyone, and see you next time.
Thank you. Have a good evening.